Let's move on to pharma, and of course the big story there is the twists and the turns for the Fortis deal. In fact, the revised offers have only spiced up the race as TPG Manipal has revised the offer the second time following the aggressive bid from rivals, better valuations for Fortis hospital business and a more favourable swap ratio for the shareholders. Let's bring on board Ashwin Mohan. He's been tracking these developments from day one. And Ashwin, tell us what's the latest?
The latest revised offer that has come in from the TPG Manipal consortium is clearly an indication of the bidding war getting intensified with every passing day. They have been in this race right from day one. They have had maximum access to Fortis Healthcare. They've also had the opportunity to carry out more due diligence. But even then, they have been pressurized to not change their deal proposal once, but twice. So this is the second time that they are revising their offer because all the other players and suitors have upped the ante, like KKR, like Munjals and Burmans, and even IHH. So the revised offer essentially is favorable because it imparts more value to the hospital business of Fortis, about 260-270 crore rupees higher. It also has a better swap ratio. That's not all. They've also arranged for funding. They've got interim nod from ICICI Bank of about 750 crore rupees. So that's also been taken care of. But, they've also cut their risks in this second time revised offer. What they have said is that they are okay with the proposed merger of SRL and Fortis, but they will go ahead and support this merger only if there are no allegations or there is no adverse consequences out of the ongoing probes involving Fortis and its promoters. So that's something on the legal liability bit where they have cut down their risks. But right now it's very, very closely perched. If you look at the offers, you look at what Radiant KKR have offered, their offer has been perhaps the most aggressive one in the 170 to 175 rupees per share range. So one has to look at it from a valuation point of view, and also one has to look at it from the sense that perhaps KKR and Radiant is the most aggressive offer so far, despite them having not got the kind of access to Fortis Healthcare which the original bidder TPG Manipal has. But now, of course, all eyes will be on the expert panel, which has been set up under the chairmanship of former PwC India chairman Deepak Kapoor. They will assess these offers and then they will advise the Fortis board on what to do. So all eyes on that meeting tomorrow. And because the meeting is tomorrow, that's why all these revised offers are trickling in. All the suitors making one last-ditch attempt to impress not just the board, but also the expert advisory committee.
Ashwin, in fact, we had spoken to Manipal when they brought in their second revised offer, and at that time they were quite hell-bent on sticking to the new revised offer of about, I think, 155, if my memory serves me. But of course, as and when more suitors have come in, they as well have been prompted and, may I say, forced to really up the ante. Thanks, Ashwin, for the latest on that. But Radiant Life has not revised the bid for Fortis, but just changed the structure. That's the word coming in from the co-founder and director, Abhay Soi. In an exclusive conversation with your channel, he says that there must be time for due diligence and then let bidders bid for Fortis. He also says that Fortis could actually sell an asset first to alleviate the cash burden. Listen in.
The more essential part of the bid is that we put a binding offer for 1,200 crores for purchasing one of the assets which alleviates the financial concerns of the company. So obviously, evidently, there seems to be a lot of interest. A lot of people have been bidding for this asset, and there seems to be some sort of emerging bidding war. So, but we've also read that the company may not have time, and they're not allowing due diligence because the company requires cash infusion urgently. So what we've suggested is instead of selling the farm or getting into a truck with somebody at this stage without discovering true value, why don't you sell one of the cattle heads? Effectively, 6.5% of your total bed strength lies in your Mulund asset. So we will purchase that for a value of 1,200 crores. This asset sits in the RS books that be of, I think, about 680 or 700 crores. So this allow them about 500 crores or 600 crores of cash. And they can thereafter open the bidding process, allow for due diligence, and open a bidding process for all the suitors. Perhaps the best way forward is to allow people 3-4 weeks, maybe do a vendor due diligence, share it with them, and let people bid. But if what the driving factor is that is dearth of cash at this point of time, then there are other ways of creating that as well. You don't have to take a high amount of debt. You need to perhaps monetize one asset out of the 30. If Daiichi does come and block things in court, so be it. Other than that, this transaction pertains to Fortis and not to a particular shareholder of Fortis. What my understanding is that the issue Daiichi has is with a particular shareholder and his asset base, which in this context would mean 0.87 or 0.67% of Fortis.